to ET Now, and this is Buy Now, Sell Now with me, Karunya Rao. Let's start off the show by looking at the top headlines. You have healthy gains coming in. Look at Lupin and the way the stock is buzzing in trade. USFDA not for asthma drug is something that's aiding the up move on the counter.
All right, thanks for that, Karunya. I'm also on the show today. Hi, everyone. Healthy gains, like Karunya just pointed out, but there's also been some deal math. Axis Bank is to buy 17% and not 29% stake in Max Life. That's a recent change. They were expected to pick up 29%, so there's been some changes on that front. And nonetheless, they will have a controlling say in what happens at the insurance entity once the acquisition is complete. Next, upgraded yet again, SBI in focus. Goldman Sachs joining the brokerage list. Very bullish target, 282 rupees per share. Second one after CLSA. And the next one, which comes as a bit of a surprise, is a stake sale in Phoenix Mills. Promoters are selling via block deal. They just completed a QIP over the weekend, 1,100 crore rupees, which 40% was bought by GIC Singapore. So that's another key counter in focus. Then we have liquidity booster shot, a 10-year yield finally easing post the special RBI OMO. So that's some movement in the bond space. And then we have the KV Kamath exclusive to ET Now. Banks must ensure that they are adequately capitalized. That was the main takeaway from his interaction. And that's also got the entire banking sector in focus. Karunya.
Okay, let's move right on and talk about some important earnings that trickled in as well. You have LIC Housing Finance, an important one, and one of the top gainers as well as far as the broader markets are concerned. So let's touch base with the management of the company to understand what transpired, the way forward as well, and the trends that they are witnessing at this point in time. We have the management, Mr. Siddharth Mohanty, MD and CEO of LIC with us this morning. Thank you so much for taking time out, Mr. Mohanty. You reported a better than expected profit of 34% YOY. At a time when the companies have accelerated provisioning, your provisions have declined as well. Once again, if you compare to the same quarter last year. What is the outlook on provisioning for the rest of the year, if you could shed some light?
You see, we have done adequate provisioning. Our provisioning coverage ratio is 45.32% today. So 2,669 crore we have provided as against our NPA of 5,888. So I don't feel there is any issue because we have adequately provided for that.
And how do you see your profitability shape up during FY21? Do you expect lower provisions to aid profitability in the upcoming quarters?
You see, despite COVID, we have shown some marginal growth in our revenue. That also you have to take into account. There is positive growth, maybe single-digit growth. There is a growth in revenue. And coming forward, I feel, looking to our experience in July and August, there will be definite growth in revenue. And so far as this moratorium and provisioning, all these issues are concerned, you see, moratorium is for those accounts which are standard up to 1st March 2020. So our objective would be all these accounts are back on track in September because moratorium ends 31st August. So hopefully, because those were standard as on March, we are very much sure they will be on track in September, at least individual retail housing loan accounts. So I don't find there will be any issue in the coming days so far as our provisioning or revenue, all these things are concerned.
Your moratorium book stands at 25% of the company's total loans under management. Given that the moratorium is coming to an end this month, what are the trends you expect or you foresee going forward?
You see, when moratorium was initially given, we experienced some 29% of our 29% plus portfolio, those were under moratorium. But after that, it has been reduced and today it stands at 25% of the book size. And if you see individual retail housing loan, that is just 16%. And number of accounts which are under moratorium today, it is below 12%. People who have opted for moratorium, they have started paying last June, July. We are experiencing people, though they have opted initially in the month of April and May, they have also started paying. So we are in retail individual housing loan. That is the major portfolio. So we do not find any problem in the coming days.
So, and you know, one particularly encouraging thing is that you've managed to maintain your asset quality during this quarter despite a very tough macro environment. So how much from within the morat book do you expect could possibly turn into bad assets? And then in that case, what's your outlook on NPAs for the coming quarter?
Actually, if you see, once government, RBI, they announced moratorium, immediately we swung into action. We have our special team which is monitoring each moratorium account. Officers have been engaged to monitor each moratorium account. They are in touch with the customers, and hopefully all those accounts will be on track in September. So I do not see much of issue in the coming days so far as the individual housing loan is concerned. But so far as builder book, there is major constituents, they have opted for moratorium. Let us see. But the builder book constitutes less than 7% of our total book size. So overall, I don't see any problem for LIC Housing Finance as such once moratorium ends.
The pandemic has resulted in people realizing that the need for an own house or own office. Do you see demand and sales going up with more people wanting to buy their own place? Share with us, if you could, any trends with regard to disbursement trends?
Absolutely. You see, home as a sense of security, that has been further reiterated in this days of pandemic. Now people are working from home. All these new concepts have come, working from home. So more and more people are now going for home, and it is the right time for individual home seekers, home borrowers to go for home. This is the right time because price have been stabilized and they should go for home. Our experience is last 2-3 months, June, July and till date August, we are experiencing a very positive growth in a retail home loan segment, particularly affordable segment. And if I say my experience in July and August, as against last year, previous year of this period, we are experiencing positive growth. So that makes me comfortable to ascertain that this individual loan segment in the current year, definitely there will be positive growth despite all this economic slowdown and pandemic. There will be some growth in the individual retail housing loan segment.
Right, sir. And you know, if we look at the overall loan portfolio, it's witnessed a very subdued 6% YOY growth. Now, how do you see credit demand panning out across the various sectors? Do you have any forecasts for FY21? And it seems that retail sector being in focus, where would your focus lie within the retail?
You see, within the retail home loan segment, particularly, as I told, affordable segment, there we are experiencing a good growth. And within affordable also, this PMAY, Pradhan Mantri Awas Yojana, that is most popular and more people are going for that. And we are thankful to government. They have extended this CLSS, Credit Link Subsidy Scheme, up to 31st March 2021. So people take advantage of that because straight there is a subsidy up to 2.67 lakhs subsidy is there. Besides that, we have also launched some products to attract individual retail home buyers, those who are going for ready-to-move houses. We are offering 6 EMI waiver in staggered manner after 3 years, after 6 years, after 10 years to each. So those are very attractive, and as I told people, this is the right time to go for a house. More and more people will go. And besides home loan segment, other segment also, there is some slight growth, particularly projects which are catering to this segment, projects which are for affordable housing. So those also we find there will be some positivity. And our experience is in last 2-3 months, particularly tier 2 and tier 3 cities, from those areas we are actually experiencing growth. Positive growth is there from those areas as compared to big 7 metro. So tier 2, tier 3 city, good growth is there.
All right, Mr. Mohanty, pleasure to have you on the show. Thank you so much for taking time out and chatting with us about the way forward and your numbers for the quarter gone by. Meanwhile, RBI annual report for 2020, FY 2020 is out. It says that the full macro effects of COVID-19 for India are difficult to assess. The balance sheet rose to 30% YOY at the end of June 2020. Government consumption is expected to continue. Pandemic proofing of demand going forward. The private consumption is expected to lead recovery when it takes hold. They have seen some retrenchment in activity as well that is unprecedented in history. Well, Maithili Bhusnamath is joining with us on the phone line. Maithili, hi, morning. Going by the key takeaways of RBI's annual report, what really stands out for you?
Well, much of what is said in the annual report is what is already known, because we do have very detailed statements from the MPC, the minutes of the MPC, where the discussions are all laid down in detail. So there's nothing very new really in the annual report. In fact, the one thing that perhaps all of us would look forward to in the annual report is the RBI's annual account. Because remember, this year RBI transferred only 57,000 crores odd to the government by way of dividends, when the budget estimate was 60,000 crores. This was substantially less than what it had transferred the previous year as well. So at that time, no further details were known. So I think one will need to go through the RBI's income and expenditure statement to find out what is it that has resulted in the RBI not being able to transfer more. Because this is a time when the government is really strapped for funds, and it would have looked forward to any additional support from the Reserve Bank of India. Apart from that, I think what is clear is that they say that private consumption would lead recovery. Clearly, the RBI is not pinning any hopes at all on investment. Given the fact that we basically have two drivers of growth, investment and consumption, the fact that the RBI says that private consumption will have to lead recovery, and also that it is government consumption which is going to be doing the pandemic proofing, the indication is very clear that at the moment the RBI still hopes that the government will do something to shore up consumption, even as it warns that the fiscal space is limited. So I think there's nothing very new. We'll have to go through the annual report, as particularly the statement of income and expenditure, to find out what exactly led to the decline in the transfer. But apart from that, I think there is nothing very new as such, except, of course, the usual warning that how this is perhaps the most unprecedented kind of crisis, and what the RBI and the government should do and can do, have done in the past. Good to have you with us. So I don't know whether you managed to get time to see the annual report, at least the first chapter of assessment and prospects. Basically, it talks about, that private consumption must lead recovery, and that government consumption would be the only way of pandemic-proofing demand. Does it mean that the RBI has almost given up on investment returning, at least in the near term, Pranab?
Yes, I think they have, and I think that's a sensible thing to do. The fact of the matter is that until capacity utilization goes up to somewhere near 74-75%, you shouldn't expect to see any strong investment movement. And we are very, very that. So at the moment, the principal action will be on the working capital front, trying to get the capacity utilization up. But investment as a driver of the demand side, I think is something that we cannot even hope for till probably end of next year sometime.
Spending as having some kind of a multiplier effect. Would not government investment be a better way of going about it than government consumption? Because investment would not only create some assets, it would lead us to increase in consumption subsequently, with a one lag delay as it were. So So wouldn't government investment, say, in infrastructure, which so many of us have talked about, wouldn't that be better than outright government consumption, which really doesn't give you any long-term assets at all?
Well, government consumption is a kind of nebulous term. What tends to happen is anything that is shown as non-capital is treated as consumption, but that's not really the case. So to give you an example, if the government transfers money into Jan Dhan accounts, that would be treated as a transfer and therefore as consumption. Now that has a low multiplier. But if the government actually consumes by buying goods and services, then that has a much higher multiplier. Investments, on the other hand, uniformly will have high multipliers. The point really is, what can you get off the ground quickly? Investments take time because projects have to be developed, they have to get the requisite approvals, frequently land acquisition has to happen. So investments can take a lot of time to get off the ground. Now, if the real focus is on quick movement, then the right way to go about it is plan for investment, but start with consumption.
Tanya, the principal economic advisor said that now we are in a position to push the accelerator, suggesting that there might be that long-awaited second round of stimulus. What is your reading, Pranab? Clearly, there is a case for a second stimulus, but is the government now veering around to the view that yes, they will do it? What is your reading of the situation?
Well, at the moment, the situation to my mind looks a little grim because the government has so far given no indication as to what are the kind of expenditure items they're actually looking at. I hope that work is going on behind the scenes. But frankly, given the sort of state of confidence in the economy, statements should be made now. Even if the expenditure doesn't start, at least the government should be playing up the sentiments. And that is something I'm not seeing, and I'm worried that the government may actually simply be sitting on its hands until such time it thinks that it's time for them to spend. But, that may be because if the confidence erodes even further, then the problems become more intractable.
For the first quarter, which is expected at the end of the month, 31st August, be the trigger because the estimates have ranged from -10 to -25 to perhaps even more. So could that be the trigger? Because that would really affect sentiment very adversely. And if the government were to remain quiet even after such adverse numbers, that would be very damaging for sentiment. So could the government possibly be waiting for that 31st August number?
Well, I think they are waiting for it, and that is what worries me. Because if the numbers come in bad and then the government starts to move, we're going to lose valuable time. But anyway, we are almost there. But I just do hope and pray that the background work has already been done in the various ministries. If not, I think we are in for a rather extended slowdown.
The government's continued reliance on bank credit and this constant push to banks to lend more. Could we be risking a repeat of what we did in 2008 when we pushed banks to lend to many of the instances where they really were not, credit-worthy borrowers? In the case of the MSME sector, yes, the amounts involved are smaller than in the case of large corporate borrowers, but the numbers are very large. So, given that the MSME sector is also the most vulnerable, are we really sitting on a time bomb?
Oh, we are in any case sitting on a time bomb. Michael, we keep forgetting that the Mudra loans have been given moratorium since last year, September. So there's a ticking time bomb there already. Now, what has happened now is actually fairly interesting. In 2009, the problem was that the banks were actually doing evergreening on their own. Now what has happened is the government has given the official sanction to do evergreening. So that makes it fairly interesting. And, yes, we are looking at a ticking time bomb. The first indication I think we will get is in September when all the moratoriums run out. But the problem can actually become a lot worse next year.
Pranab, one last question before I let you go. The first NPC term is now virtually at an end. In September, that term comes to an end. The hope was that given the pandemic, the government might think of some exceptional clause or bring about an amendment to extend the term. But there doesn't seem to be any response from the government on that score, though the RBI is understood to have asked for an extension. Will bringing in new external members, 3 external members, even though the governor has a casting vote, would it create some kind of a situation where perhaps an additional element of uncertainty, if I could put it that way? Could it have been avoided?
It could. Yes, I think the extension of term is absolutely essential. First of all, the outside members are experts who have actually developed the models that they use for the MPC discussions. Now, these things don't happen overnight. I mean, you can't expect to appoint somebody today and to hope that she would be up and running the day after tomorrow. It just works like that. So what I would do in their case would give the current MPC at least a 6 month, if not a year, extension, and begin the process of nominating successors so that they have time to ramp themselves up.
Absolutely, Pranab. I couldn't agree with you more. And thank you so much for joining us. And with that, it's back to the studio.
Pleasure.
Happening, or should I? Thank you so much to all our guests and Maithili Busramat as well for joining us and for helping us decode what essentially the commentary from the Reserve Bank of India essentially means at this point in time. Let's shift gears and talk about RBI's announcement of special OMOs. They'll be auctioning them on August 27th and September 3rd. Puram is standing by with more details. Okay, we don't have Poonam with us yet. We'll try to reconnect with her. Meanwhile, let's get you the big ET Now exclusive. A stalwart of Indian banking space, Mr. K.V. Kamath, shared his mind on the future of banking in India and how lenders are gearing up in this new normal. He had this conversation earlier today with Nikunj Dalmia, where he said he sees retail consumers emerging as the mainstay of banks globally. Listen in.
20 years back, not too long ago time, 2000, they were still leveraged. Net of total debt to equity, maybe 3.5, 3.7 is to 1. By 2009, the leverage became 1.7, 1.8 is to 1. Today, if I look at the Sensex 50 companies, maybe 35 of them are virtually with no leverage. So they are actually self-financing themselves, not necessarily even private equity. The cash accruals are enough to do most of their funding. Others have nominal leverage. MSMEs still have leverage, but I think they also will grow in this new India that I'm picturing to a level where cash generation will be sufficient to meet a large part of their needs. The market, the capital market, and the private equity players will fill what is not available through cash generation. So the banks as purveyors of long-term funding, I think may not necessarily be the way forward. Private equity capital markets will increasingly become the source of outside capital, with a large part of the capital. By a large part, I mean maybe 60-70% coming from internal generation. I think this is going to be the future in my view. So where will banks lend? I think there are a whole lot of other activities the banks will have to lend. I think part of working capital will have to be financed, and a large part of retail funding. The retail consumer will be a borrower, and this is true universally. We are seeing that the retail borrower continues to be the mainstay of banks globally. So he would continue to approach the banks, and the banks will find that as the market space going forward, along with a variety of products, financial products. The banks will provide both the corporate customer and the retail customer. last word on this from my side, these products will increasingly be driven online rather than in the physical space as we now do. Having had in my mind, I had a picture of where we would be 1 quarter down from March. That was a dire picture we could. I don't think the picture is dire as we thought it was. What is the dire picture? The dire picture was the question, can industry at all start in 3 months' time with the lockdown 1, lockdown 2, and the conditions that were put to open up businesses? Not only business, but then you have to get the supply chain also going. Whether we would at all be able to kickstart the economy. But I think everyone would agree that today when you look at the performance of companies getting their own businesses up, they may be working at anything between 60 to 80 or 90% capacity. But to me, that was not to be. I thought that they would be still struggling to open. The supply chains are in place, which means that the supply chain, basically, the components of it are our MSMEs. So they are coming in play. And then, of course, you have a distribution channel that is happening. So I believe that we are at a much better place than we were 3 months ago. And this fear of what happens to moratoria after August, I don't think is real. Let me put that in context. Today, our bank lending, what is it? About 40% is to retail India. Now that banks have an opportunity to hit a reset button through what the Reserve Bank offered on August 6th. It is now up to the banks to act at speed to do that, for their own health and the health of their customers. Now, here again, if you look at the customer, these are all performing customers as on a particular record date, which was just before COVID started. And to that customer, I think a 2-year reset should be more than enough to handhold him through the current challenges that he's got. That is the retail. You look at the corporate book, you then have packages that have been given to various groups of lenders. Agriculture has had a package. MSMEs have had a very large package. That left a large part of the rest of India, the corporate side, the infrastructure side, to be attended to. And I think that is what just now, through the August 6th guidelines that Reserve Bank announced, and by September 6th, they want to announce the operating conditions for this. I think we should have something in place.
Now, our guests are now with us, Kunal Batra and Shaina Mukadam. But Kunal, coming to you first, good morning. What are we seeing right now? The US handover was really strong, Dow up nearly 400 points, futures also still up above 100 points. Why have we suddenly seen a reversal from the morning highs?
So good morning, Varun. I think it's to do with what's transpired on the expiry and the options data front. So I think if you look at the options, payoff over the last 4-5 days, particularly I think from Thursday, onwards or previous Thursday onwards, the options data indicates that the 11,500 mark had seen a very high kind of an open interest built up. Yesterday, apparently you saw 11,400 acting as a very strong support zone. So I indicated this in the morning as well that the Nifty would face resistance after this initial 20-30 point gap up. I believe that we should now continue to trade in this very, very narrow and very, very tight band, 11,400 as a support and 500, 525 approximately as a resistance. The outperformance, which will probably transpire, would happen in the Bank Nifty front, and I believe that's going to be one index which still looks extremely strong to me. So I think the Nifty would consolidate, for a couple of days, unless the options data changes dramatically. But Bank Nifty is the one which I believe could head up higher.
Right. Shahina is also with us. Shahina, hi, morning. This month has been quite, stellar in terms of the benchmarks and even the broader markets for that matter, and the way they've moved up. Are the fundamentals equally strong for this to sustain, or like Kunal, do you believe that now it's likely to be more range bound?
I agree with Kunal. I believe it is going to be range bound. Like for example, today morning we had a nice new high, a nice rally, but the market is not able to sustain those type of moves. On the other hand, I think most of the negative news is more or less digested by the market. For example, the COVID-related impact in terms of on the earnings has sort of been digested because we have seen a lot of companies come out with negative earnings, and we've not seen that impact on the stock price. On the other hand, any strong earnings that have come up have seen a good rally in those particular stocks. So I think it's going to be a market of consolidation and stock picking, whereas one goes in and buys businesses or stocks where you think that this momentum will continue in terms of positive growth and should do much better in better times.
Okay, great. Thanks for that, Shaina. Kunal, coming back to you, I see you have a sell on JSW Steel this morning. So what's that about?
So I have two recommendations. One is JSW Steel sell. I think this steel major has had a fantastic uptrend. But what it has already done is that in the last, I think, 17 or 18 trading sessions, the stock had has climbed up pretty much on the steeper kind of a territory. Indicators have got back into an overbought kind of a zone. So I would expect some bit of temperament into the stock price. So I would expect the stock can come back to 270, 272 kind of support levels before resuming and continuing its structured uptrend. So a very short-term oriented sell call on JSW Steel, target stop 272, stop loss revised to 290. The second is a bond Tata LIC. Again, a completely different chart over here. Both on the short term as well as on the longer term charts, the stock has done exceptionally well, trading now at fresh 2-week highs for itself. I believe Tata LIC looks good for another 30-35 rupees on the upside. So buy with a target of 1130, stop loss at 1080.
Okay, thanks for that, Kunal. It's two calls, sell on JSW Steel and buy on Tata LIC. Moving on to our viewer queries. First up, it's a Twitter query from Mr. Tushar. He has bought RBL Bank at 122 levels. At this juncture, he wants to know if he should add more. Right now, the stock is perched at close to 190, 191 levels. Should he add more, or should he stay put with his investment and look for better levels to exit, or any other stocks that you'd like to recommend, Kunal?
So I think if it's from the banking pack particularly, that's where I'm assuming you are coming from. Then I believe that stay invested in RBL Bank. I think this 200 mark should be taken out pretty soon for the stock, and I think if that happens, maybe the stock can give a flurry kind of a strong price up move. So many of these banking names have seen a lot of short built up, and if there is any round of short covering which happens into these names, the short covering tends to be very fast, and it tends to leave a very swift impact on the stock price. So I would suggest hold for RBL Bank. But if you want to look, if you're looking to put in extra money, then why look at just RBL Bank? I think you have ICICI Bank, you have HDFC Bank. Both of them, they look very attractive. Kotak Bank also has just about shown signs of a breakout, or it's on the verge of showing signs of a breakout on the short-term charts as well. So if the bank nifty moves up higher, it would need prime support from the large cap names like HDFC, ICICI, and Kotak Bank, rather than stocks like RBL Bank, which can probably move up on an individual kind of news flow. But I think for a structured uptrend on bank nifty, you have to bet on those 2-3 key large cap private sector banks. So I think rather than putting extra money on RBL Bank, I would suggest that you can diversify and put in some bit of more some capital, some portion of your capital onto stocks like ICICI Bank, HDFC Bank, or Kotak Bank.
All right. Thanks for that, Kunal. See, Shaina, Kunal is betting on the larger players, and they are really the index drivers for the Bank Nifty. So perhaps he sees that there's a more focused approach there that can give you a better return. And while I agree with that, what about RBL being A, where it's at, B, multiple fundraisers just completed in the last 6 months? And if you look at the operating metrics of RBL, you'd know more about the fundamentals. They're pretty firm. So what's your call here?
Yeah, I will also agree with both of you that one should be invested in some of the larger banks like ICICI Bank, HDFC Bank, and definitely you're going to see good returns there. At the same time, RBL at the current levels, I would hold. To add, I would wait for slightly lower levels, maybe closer to 170 odds. I think, but the results that they declared were very healthy. You have a provision coverage of now almost 53%, which it shows an improvement. The net NPA margin has also improved. At the same time, I think there is a bit of risk over here because a lot of credit is towards the micro as well as credit card. RBL has a lot of exposure there. And so the moratorium, how it plays out over the next couple of months is going to be a challenge. And I think that is the reason why one should be a bit careful on adding on RBL Bank as of now. But definitely you can hold and do add at lower levels.
Experts there think that there's a lot more attractive stocks if you're looking at banks. But that being said, if RBL gives you a decent correction, you can look at entering. Let's now move forward to our next query, GMM Fodler. And Kunal, the chart on this one is one of the most spectacular in recent times. Do you think there's more juice left?
It's difficult to ascertain whether there's more juice left in the stock price, but these stocks, they tend to fly up high for a very short period of time, and that requires when the market goes through a full throttle upside, especially on the mid cap front. So GM Fodler as well, no exception, from 4,000 to 7,000 in just a matter of, I think, 1 week, and then the stock is consolidating. I would advise viewers that play with a momentum kind of strategy into these kind of names. So if you're looking to buy these stocks, because these stocks, they tend to run up quite swiftly, it tends to garner a lot of attention from long-term investors. But they, unfortunately, they tend to buy these stocks, these kind of names, at much higher level of the price target, rather than buying these stocks, when they go through sharper periods of correction. So I think in that regards, I would advise that have a momentum-based strategy so far. If the stock doesn't show any kind of momentum, it doesn't make sense to stay invested into these names unless the stock goes through a very sharp period of correction. So I think either if the stock comes to 5,000 levels, it becomes very attractive from a short-term play to go for a contra buy, or else if the stock breaks above that 6,500 zone yet again, then I believe that momentum could probably come back into the stock again.
Okay, Shahina, what is your sense on GMM Fodler?
I would agree with Kunal. I think the rally in the stock has been very sharp, and the valuation does not justify this type of this type of movement. If you see the PE, it's like more than 100 and some 20 times or whatever if you see the last year earnings. And even if you see a good strong growth, I still think the valuations are expensive. Price to book also is more than 25 times. So I don't think one should really be looking at that stock as of now in terms of investment. In fact, I would be selling and getting in at lower levels. While I do think that the consolidation of the global level, wherein the promoter group is investing and buying out some stake from the parent company, and they're investing about $150 million. I think to that extent the balance sheet is very strong and it can take that stress. But I think the stock rally has happened on two factors. One is maybe this is news, so sell on news, and the second is of course that they are the leaders in glass liner, and the pharmaceutical industry and chemical industry is doing well, so there is a good demand for the products. So if you're really looking at a very, very long term, 5 years, 10 years, then it is a good investment. But at the same time, I think an investor, if you're invested, do take your profits as of now and look at reinvesting at much lower levels, around at 4,500, 5,000.
Okay, that's the verdict on GMM Fodler. Thank you so much on that note, Shahina and Kunal, for joining us this morning. And thanks to our viewers as well for reaching out to us on a daily basis, asking us a host of queries and stocks that we discuss on the show. Moving on then to an ET Now Insight. Do remember that the Nifty closed at the highest level since 27th Feb 2020. What is the road ahead? Jayesh joins us with those insights.
One of the parameters to gauge whether the rally has been broad-based or not is to look at the number of stocks that are trading above or below the 200-day moving average. And for the Nifty, currently 70% of the stocks have been above the 200-day moving average, which is the highest level that we have seen in over a year. That to say is the pre-COVID levels as well, where we had about 60-65% stocks that were above their respective 200-day moving average. So, current level of 70% is definitely higher than those levels as well. Also a point to remember that, earlier this year during the market correction, there was, less than single-digit number of stocks that were actually trading above the 200. So from there to rise up to 70%, that is a phenomenal run that we have seen. And that has been broad-based participation that we have seen from the market stocks as well. However, there are still key stocks that are trading below the 200-day moving average, which could actually have an impact on the markets as well going forward. And especially the banking stocks, you have the likes of IndusInd Bank, Axis Bank, and SBI, which are more than 20 to 30% away from their respective 200-day moving average as well. And then you have the likes of ONGC, Coal India, IOC as well, which do not have material weightage on the index, but they are still below their 200-day moving average. Among the key stocks, you also have ICICI Bank as well as Bajaj Finserv, along with HDFC and L&T, which are still about 8 to 10% away from their 200-day moving average. So in case these stocks actually move higher, we could see elevated levels for the markets going forward as well.
Okay, thanks for that, Jayesh. Let's now pull up the BNSN stock cloud for this morning, and we have 10 stocks that are fairly active, beginning with LIC Housing. I think it's definitely up in trade despite the cool-off that we've seen. We had the LIC head talking to us just a couple of days ago, and a lot happening at that company. We then move forward to Phoenix Mills, which also has a lot going on. They had a QIP recently, plus we're hearing of a block deal share sale from the promoter today. You have SBI on the back of a second big upgrade coming in from Goldman Sachs versus CLSA that we spoke about earlier. We have a Max Financial that's now there because Axis Bank's transaction has seen some changes in terms of overall value that they'll be buying, 17 versus 29. We then have an ICICI Bank in there as well. We have a Lupin on the back of approval for an asthmatic drug treatment that just came in this morning, and that counter was in focus. Future Retail, because they were actually able to repay some debt yesterday. People were worried about a first default, but they did manage to make some decent interest payment. IRB Infra is also in there. Prince Pipes has just 3-4 hours ago, or maybe yesterday actually, done a tie-up with Lubrizol. So now going to get some good IP and know-how from there. And IEX, as they've accepted the resignation of a board member recently, the head of the company is resigning. So that's got that counter in focus today.
Okay. Welcome back. You're still watching Buy Now, Sell Now. Bond yields have spiked, but what does it essentially mean for debt fund holders? Find out from this excerpt of a chat which Mubina had on the Money Show last evening.
Okay, so let's not use jargons and let's use simple words. In simply put, what is a bond yield? Let's understand that in detail. So a yield is a return, and bond is a sort of a security which government or a corporate offers to consumers that, look, this is a bond which we are offering you. It has a yield, which is also called as a coupon rate. They invite the consumers to invest in their securities in return of a rate of interest. So bond yield actually means the rate of interest that the consumers should expect in return of their money. So suppose the coupon rate is 6%. When I say coupon rate, it's same as bond yield. So that means if a consumer invests 10 lakh rupees in a bond, then he is likely to get 60,000 rupees per annum as return, which is also a yield. So in times to come, suppose that bond is for 5 years, lock-in tenure, and we say that the bond yield has increased. That doesn't mean that the corporate or the government have started giving more interest. Basically, what it means is that because the bond prices have gone down, hence the person who has actually invested in a bond is looking for a exit at a lower price. Since the price is low, the yield automatically increases, and hence instead of 6%, it goes up to, maybe by 1, 2, 3%, as you rightly said, and it has been on the up mainly because of the demand and supply factor. So that is for the consumers to understand that the yields are fixed at the time of the bond when it is offered to the consumer, but the fluctuation is due to the demand and supply.
Demand and supply of the bonds, essentially. So basically, all these bonds carry a fixed interest rate, 6%, 5%, 7%, etc. That does not change. Like Rashid mentioned, if let's say you've bought bonds worth 10 lakh rupees, every year, if it's fixed at 6%, you are going to get 60,000 only. However, it is the market yield that sort of changes, or rather the bond prices that change. So if the bond prices go down, this return, or this yield rather, return may not be the right word, but this yield essentially goes up. And vice versa. If the bond price goes up, then this yield comes down. Okay, now Rashid, let's understand it from the aspect of debt funds, because usually when it comes to fixed income, investors and retail investors especially do tend to invest in debt funds. So between a long duration fund, a medium duration fund, and a short duration fund, how should investors across the the spectrum of these debt funds understand what is the impact of this spike in bond yield, and also would it differ, or should short duration and long duration bond holders think that, okay, it's gone up, that means it's negative for me, period?
Yeah, so again, it's very important for consumers to understand this. When they are investing in debt funds, they should always understand the tenure which is remaining for that fund. So suppose the tenure is very short, then the volatility risk also becomes short. But if the tenure is very large, say 9 years is left, 9 years will automatically have a lot of impact when it comes to volatility. So they will see their price fluctuate a lot. And when it comes to debt instruments between 1 to 4 years of residual maturity, when I say residual maturity, the bonds might be 10 years old, but only 1 to 4 years are left. Then that means primarily the accrual of interest payments of those papers will actually define the prices of the bonds and the correction. As a consumer, if somebody has a horizon in mind, I would definitely suggest them to divide it in a way that even this volatility doesn't affect them so much. In shorter duration, volatility will be the least, but as the duration increases, the volatility will increase in terms of the yield and in terms of the bond prices.
Okay. Switching gears a bit, it's M&M week here at ET Now. We've been covering managements from the group all week long, and today we spoke to CP Gurnani of TechM and tried to understand his plans to beat the COVID blues. Here's a slice of that conversation.
I answered the same question when you had asked me at the end of the quarterly results. And what I can again repeat is that overall the demand is good. As a matter of fact, when I look at my deal pipeline, it is the strongest that Tech Mahindra has ever seen. More importantly, what we are seeing is some of the sectors, particularly telecom, BFSI, retail online, and healthcare, are showing a fair amount of uptake. So I can only say is that we feel good about where we are in the market and the way overall the scenario is building up.
Probe that a little further. You've always talked about how new age technologies will be the drivers for change, for growth going forward, and how Tech Mahindra is well positioned to take advantage of that. What's the kind of opportunity that you see here? You have sounded, confident, and you continue to sound confident on Q-on-Q growth going ahead as well. But give us a sense a little deeper in terms of the kind of opportunity that you're seeing here.
So let's take a step back and divide this conversation into what I would call pre-COVID, during COVID, and post-COVID. Now, clearly, before the Wuhan crisis, the COVID-19 crisis, the industry was in a relatively a cruise mode. We were all expecting the 5G to become an accelerator of the business during 2020. And in a lot of ways, the migration to cloud, the modernization of the data services had taken off in the right earnest. During COVID, there were challenges. And the challenges were primarily in supply chain, manufacturing industry, and aerospace, travel, leisure.
With that, we're going to wrap it up right here on Buy Now, Sell Now. Thank you so much for tuning in.